The Federal Reserve released its probe into the collapse of Silicon Valley Bank.
The feds took a critical look at what they missed when the bank rapidly grew in the years leading up to its collapse. Earlier this year, Silicon Valley Bank was one of several that failed, sparking fears about the stability of the banking sector.
CBS News reporter Sarah Ewall-Wice joins us now. Sarah, the report found there were failures at Silicon Valley Bank and with its regulation. Can you elaborate on what those failures were?
Yeah, so Vice Chair of Supervision Michael Barr called this report a, quote, unflinching look at the conditions that led to the failure of Silicon Valley Bank. First, it found that the board and the management at the bank failed to manage their risks, both in terms of the liquidity and interest rates. But at the same time, it found supervisors did not fully appreciate the extent of the bank's vulnerabilities as it quickly grew. And when they did identify those vulnerabilities, they did not take sufficient steps to address them quickly. While this bank was rapidly growing, it had a long transition period to meet those higher standards. So supervisors needed more time to make assessments. It also noted that supervisors did not want to appear to be pulling forward large bank standards on small banks. I think it's worth noting that by the end, the bank had 31 warnings at the time of its collapse, 3 times the average. Supervisors plan to downgrade SVB's rating related to interest rates, but the bank failed before that was finalized. The Fed also said that law passed in 2018 and shifting policy stance led to reduced standards and less assertive supervision.
So, Sarah, where will the Federal Reserve focus on improvements, moving forward here?
Yeah, so this assessment is really just the first step in the process. Vice Chair Barr said the first area of focus will be on improving the speed and force of supervision. They need to ensure supervision intensifies at the right pace as banks grow in size and complexity. This bank grew from $71 billion in assets to $211 billion in assets from 2019 to 2021. They're also going to look at special factors, regardless of the bank's size, like whether it's crypto or fintech, so they can identify whether there are other risk factors. Barr also said it's appropriate to have stronger standards. They're actually planning to revisit that regulatory framework. I think it's significant that they are reevaluating the rules for banks with $100 billion in assets or more. They also are going to evaluate how they can supervise, regulate liquidity risks, and improve capital requirements, which were a challenge in this case.
The report mentions the role social media played in the bank failure. Tell us about that and why it's so significant.
Yes, this is really interesting because basically what they said is the combination of social media, high networked and concentrated group of depositors in that tech sector, and technology all had a, quote, fundamentally changed the speed of bank runs. And they said social media first enabled depositors to quickly spread concerns about the bank run, and then technology led to fast withdrawals. I think it's worth noting SVB saw more than $40 billion in deposits pulled in one day, and the management expected another $100 billion the next day. And I think there are going to be a lot of questions raised about how specifically to address the role of social media in bank runs moving forward. This has been something that has been raised as a concern by both the regulators now and lawmakers. So I think it's likely going to be an ongoing debate on the best way to move forward.
Yeah, it certainly is capable of amplifying whatever kind of psychological fears might be out there. All right, Sarah Ewall-Wice. Sarah, thank you so much.